Hello, my name is Mike Smith and I'm the president and founder of T&K Futures and Options Incorporated. Today's video is going to be about the orange juice futures and options markets. But before we get started, let me go ahead and cover the risk. Futures and options investing carries significant risk of loss and is not suitable for some investors. Past performance is not indicative of future results, and you should only use risk capital when investing in these types of markets. Okay. Well, I've been trading these markets now for more than 20 years, and I hear a lot of questions from investors over that time period, and they typically boil down to about 5 of really the most common questions that I hear, and I want to cover those with you today as they pertain to the OJ market. Okay, so the first question I typically hear is, how do futures contracts and margin work? Well, margin is a good faith deposit that's required by the exchanges in order for you to go long or go short a market. So that changes from time to time based on the amount of volatility that are in the market. So quite often the exchanges will raise the margin rates if the volatility gets extreme. So they'll raise it to try to slow things down a little bit. And then on the downside, if it's really slow, quite often they'll lower those margin rates in order to stimulate more buying and selling. Try to get more people involved in that particular contract or whatever it is. But let's just assume that you set up an account and it's a $50,000 account, and your initial margin for that is $1,320 is what that's actually correct. I looked that up today. That's what it is for orange juice today. Most of this other stuff is made up, but that's true. So that's your initial margin. You got to put that aside in your account to get long or short, and so that leaves you $48,680 left over in available equity. You can leave that in there in case the market moves against you. You can get other contracts, futures contracts. You can buy options with it. Whatever you're trying to do. So that's what you have in their available equity, in this particular example. Now, the way the orange juice market works is it's a 15,000 pound contract, and every 1 cent is $150. It's OJ. I get asked sometimes, how is it pounds when it's a fluid? Well, that's frozen concentrated orange juice. That's why it's pounds. So, okay. But let's say you go ahead and get long one May OJ at $1. It's not at $1. Made that up for easy math. But let's just say you did. I want to show you a profit and loss example. All right, so you're in there at $1. Long. Market goes your way 4 cents. Okay. Well, that's 4 times 150. That's $600. That's a $600 profit for you. Pretty good day. Now let's say conversely the market goes against you by 4 cents. Well, you just lost yourself $600. So that's how the profit and loss scenarios work with the futures. Pretty cut and dried stuff. But that does lead to the very next question that I get is, about how do you manage the risk? Right here it says infinity risk. Obviously no one's ever lost infinity trading anything. But theoretically speaking, if you were short this contract, there's no end to how high whole numbers can go against you. So theoretically, you have infinite risk if you're short a futures market. To the downside, a market can only go to 0. Very improbable that would happen either. I don't think orange juice is going to go out of business, or that people are just going to stop drinking orange juice. I think it'll always have an intrinsic value. But theoretically speaking, infinity to the upside, 0 to the downside. Very improbable, but theoretically. Okay, so let's manage that risk. Yeah, and really what you should take out of this is it's very risky to trade futures, so you got to manage your risk somehow. And in my opinion, the best way to do that in this case, because you're long, would be a sell stop. If you were short, you'd have a buy stop. Well, let me just explain how this works. Okay, you're in there, you're long at $1. It's going against you, 99, 98, 97, 96. It sells through your 96 cent barrier. It automatically gets triggered as a market order. Well, the way a market order works is you're going to get filled at the next available price. And that's why when I say risk, it says 600-ish there. You don't really know what that next available price is going to be. Might be 96.10. Might be 95.80. Might be right at your 96. You just don't know. And it depends on how volatile the market is. If it's a slow day, it's probably going to be right at your price. But if it's not, it could be somewhere, you just don't know. So that's why it says risking 600-ish, because it's not precise. It's close, but not precise. I wouldn't do a futures trade without a sell stop. I mean, a stop order of some sort. You put it on, immediately put your stop on in there to protect yourself. Okay, the very next question I typically get is, what is a call option? Well, a call gives the purchaser the right but not the obligation to buy the underlying futures contract at a specified price and time. So in this hypothetical example, it's May. So you had a May 104 call, gives you the right but not the obligation to buy OJ, 15,000 pounds of it at $1 anytime before this market expires. Let's walk through this. I made all this up too. But let's say you wanted to buy that option and it cost you 6 cents. So you're buying this option and it cost you 6 cents. Well, 6 times 150 is $900. So that's the premium that you have to pay for that. And let's see how a hypothetical risk and reward example here. All right. So the market's at $1 the day you buy the 104. Market goes up 4 cents to that level. Well, that's a $600 move in the futures, but options don't catch the entire move. Options only catch a percentage of what the underlying futures contract does. I made this up too, well, not delta factor, but delta just means change. But I just made up that this option right here has 25% delta factor. It means it's going to catch roughly 25% of whatever the underlying futures market does. And again, that's an ish, because as the market's moving, that's changing. Your delta factor's changing. There's other factors involved. There's your theta, which is your time decay. There's vega, which is your implied volatility premium of your option. So there's other factors involved in option pricing. But when you want to know how much your option is going to change relative to the underlying futures contract, delta is what you care about. So if that was a $600 move and you get 25% of that, well, that means you're getting $150. So let's say you were right, market went up 4 cents. Well, this would go up in value by $150. So now your premium would be $1,050. Okay. Conversely, let's say the market went against you. Market comes down. So now you're $900, it just went against you. So I know that's confusing that you only catch a percentage and that percentage changes, but that's how it works. So when you're trying to figure out how much you're going to lose or make, knowing what the delta factor is going to tell you that. Whether you're profiting or losing on that on your trade. Next question I typically get is, what is a put option? Well, a put is just the opposite of a call. It gives the purchaser the right but not the obligation to sell the underlying futures contract for a specified period of time and price. You can bet that something's going down just as easily as you can bet on something going up in the futures market. So it's just the right to sell. You want to sell here, buy back here, make the difference versus buying low and selling high. So that's what a put is. The last question I get is, what's the risk in an option? Well, your risk in an option is limited to whatever you're paid. So let's just say you bought this, $900, plus whatever your commissions and fees were. That's your extreme worst case scenario if that option expires worthless. So you have a time period to own an option, and somewhere before that time period you want to lock in profits or cut losses. Last thing you want to do is let it expire if it's out of the money, because then it's worthless. But your risk is finite. Your worst case scenario is zero. You're never going to get a margin call or anything like that when you buy an option. Okay. I think that's about it. If you have a question, you can give me a call. Website is tkfutures.com. My name again is Mike Smith. You can find my contact information there. I also wrote a book that's available on Amazon called The No Nonsense Guide to Buying and Selling Options. And as the title suggests, it's all about options. It doesn't cover futures at all, so it won't help you if you're a futures trader. It's just an option trader. And there's another thing that might help you too, would be we offer a demo account, a free practice account, and it gives you $50,000 in virtual fake equity. But you can log in to the platform, practice trading on the platform with your $50,000 fake money, real-time trading. Find out if you're any good at it. I would suggest doing a practice account before you use any real money in this market. But that's it for today. That's the end of our video lesson for today. I hope you enjoyed it and learned something. Have a nice day. Bye-bye.